used to say you need to grow up. I know you know. Say you want to get out though. And I know, you want wine fast and you wine slow. Remember the first time when you get three, when you get naughty. Before that we are chilling, no well and party, a dance and party. Yeah, your body was so clean. You did a weird version. Back it up high, you look right. Your body die, me. Oh, God. Your body drive me crazy. Your body need a license fee. Yeah, your body at the tight that anybody who got eyes can't see. She just wanna dance and tease. 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 She just wanna dance and tease, man. Dance and tease, man. How you want to run like a nothing? I think that's for me and have my head stiff. Yeah, no fair, no cares. Because who cares? I just said yes and it never go nowhere. Yeah, I see why your heart's I see. Come baby, come try me. Everybody run by me. Yeah. Look how you twist and turn, yeah. Look how you twist and turn, yeah. Baby, I have murder, twist and turn, yeah. Look how you twist and turn, yeah. Your body driving crazy, your body need a license fee. Yeah, your body at the tight and me. Anybody who got eyes can't see. She just wanna dance and tease. She just wanna dance and tease me. She just wanna dance and tease. She just wanna dance and tease me. She just wanna dance and tease, man. Dance and tease, man.
Good evening, excuse me. To be respectful of everybody's time, I want to go ahead and get started. We are streaming this on YouTube, so if you go to the link, you should be able to find us on YouTube, or you should be able to find us on Facebook. I am Jamal Hutchinson. I'm originally from Atlanta, Georgia. I've been in Nashville, Tennessee for almost 27 years. It'd be 20, yeah, it is 27 years now. I majored in engineering my last year in school. I didn't really want to do that anymore. So I ended up doing a whole lot of different activities. I was a community activist, worked with kids, I taught for kids, did a lot of community planning. My last career, I was at Fisk University here in Nashville, Tennessee, as a academic probation specialist, and also work with students with disabilities. In that in that position, I also helped start a men's initiative on campus. I kind of fell into this business, literally, really kind of really fell in our lap at the time. My wife, she just lost her job, and one of our friends posted, said, "Hey, why don't you come check out what we're doing? I'm looking to bring on about 3 or 4 licensed agents to make about $3,000 a month." That just so happened to be my magic number, and decided to sit down with him, looked at what was going on, and lo and behold, 8 years later, we're still here. This will be my 7th year full time. October 17th, 2017 is when I got laid off from my job and just decided to go full time in this business. Um, the mission of our business is no families left behind. But our goal is that we want to help educate 1 million people about how money works, help them create a plan for now and the future. Excuse me. And we do need help doing that. Um, what I've seen, especially in the African American community, is that we don't talk about money enough. And there's multiple ways to build wealth, multiple ways to get money, but this is one area that I know that we all need to have in place in terms of understanding the right concepts behind it. Because my personal story was I wasn't taught this information. I wish I was at a younger age. And we know that statistically, only 4 out of 50 states actually have some kind of curriculum for finance as a graduation requirement. Our company, our whole thing is that we want to provide financial education and financial services for everybody. So we don't charge for our services. The way you can pay us back is through referrals, and if you do a good job by putting some of these plans in place and telling your network about us. We do get paid on the back end, so it's not a free service for real. But we do sit down with families, guide them through the process. My family actually went through the process of what we're going to talk about tonight, and some of the things I learned when it comes to insurance-based products and how to leverage them for retirement, leverage them for different things. And that's kind of go tonight is just to give you a basic overview of what is an IUL. What is this product that's been talking about on social media, TikTok, IG, etc., etc. So please use the chat. If you got any questions, type in, send the link to your friends, have them jump in and whatnot. And we're going to kind of just go ahead and get started. And I'll put in bits and pieces of my story into into this uh, 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 into this meeting as soon as I can get the slideshow to work again. So this month we're really focusing in on how the IUL works. So each week we'll be hosting webinars and seminars about the IUL. So this week is the basics of the IUL. This is kind of like the foundation. Next Wednesday we'll be talking about uh, the $1 million baby strategy. How does this work for our little people? The following week, the third week, and the third Wednesday in September, we'll be going through the family bank strategy. So there's a lot of myths, a lot of misconceptions. So we talk about the myths and realities and give you like the real deal about how to set up your own family bank. And then last week, any real estate agents, we're gonna be talking about, or anybody in real estate, want to be a real estate agent or in that field, we're going to be getting into how do we leverage IULs in real estate at the same time. So please pass this link on. The day of the event, I will release the Zoom link, but you can catch us on YouTube Live. You can catch us on these links. Once you register on the Google form, you definitely will get the replays if you want to go back and ask some questions. And please book a time with us. This, like I said, it's nothing to sit down and see what these products look like for yourself, but we'll kind of get into all of that tonight. So one of the main things that when we sit down with families is we have like four financial cornerstones that we really want to attack. We want to attack first is protection, next is growth, next is safety net, and then tax advantages. And typically we can do 3 out of 4. In our situation, we want to do 4 out of 4. Now, when we sit down with families, ideally what we want to put together is what we call a full care package. So that strategy is basically having a growth and savings strategy, protection and spend strategy, and a pass and serve strategy. So tonight, we're really going to get into what is this growth and save strategy that everybody's talking about and more information is coming out about. All right. So that strategy, typically these accounts gain between 8 to 10%. These do have cash value. It does provide that index option. Also, this money grows tax-free, protects your family, your health, and your wealth. And you also have tax-free distributions when it comes to these accounts right here. So when we compare an IUL to these other products that most people that know about, like your Roth 401ks, your Roth IRAs, your regular IRAs, your stocks, even fixed index annuities, this is just one tool that you can have in your portfolio. All right. So we always hear about this diversified portfolio. In the simplest term, diversified portfolio means you have more than one thing going on. When it comes to brokerage and stocks, it means something totally different. But what came out, I should have put the red balloons and green balloons. What came out recently as trending is, you want the red balloon or do you want the green balloon? Like, what balloon are you going to pop? So of course, it is what it is. The IUL has more green balloons, more check marks. It can do a whole lot for you. It's not the end all be all. It is not the end all be all for retirement, savings, none of that. So I don't want you to have that conception about it. But it is a tool that we all can use, that we can plug in, and then depending on how we fund it, can do a whole lot for us. All right. So I found this chart. Take a screenshot if you can. But it talks about, how do we build wealth using the index universal life model. Number one, you got to understand the basics. That's why we're here today. Next step is you got to set your own goals. How much can you afford that you won't miss per month? And listen, these goals need to be like first 3 years, first 5 years, first 10 years, first 20 years. This is a long-term approach. This is not a get-rich thing. The next thing is you have to choose the right policy and the right company that fits your specific needs. Once our company knows your goals, we can come up with the right premiums and a strategy to help you fund these policies in order that you have you can enjoy the benefit from the market growth. All right. The next piece is just that you have to. This will help you secure a piece of your future. All right. So, like I talked about before, it's these cornerstones for this IUL. They attack all these different needs: protection, growth, safety nets, tax advantages, protection, growth, safety nets, tax advantages. You always want to be thinking about how does my product provide me a safety net? Because like today, I think what it says that Nvidia had its biggest wipeout in history. What if all your retirement was tied up into an Nvidia stock? What safety net do you have in place? All right, so let's get into the foundation of how the IUL works. All right, so if you got any questions, just put a 1 in the chat, 2 in the chat, whatever it is. 3 basic rules of money. First rule of money just deals with how money grows, how money compounds. Very simple rule. I was a math teacher. Don't have to be scared of math. This is all you have to do is take 72 divided by your interest rate and tell you how fast your money doubles, how fast it compounds. First caveat is this: you cannot just leave your money in the bank and expect it to grow. It's not how it works. You go ask your bank teller, what percentage am I getting on my savings account? It's probably gonna be like 0.00000, something crazy number. Like my son, he has a Navy Federal account. They actually sent him a tax form because he earned 1 cent on his savings account. So if, let's say my grandma passed, she left me $10,000, I was 29 years old, I put that account, it was getting 1%. I take 72 divided by 1. Money's going to double in 72 years. That means when I'm either dead or still alive, I've only made $20,000. That's too long to wait. So what our company does is we show people how to earn between 6 to 12%. These IULs are earning anywhere between 8 to 10%. Of course, if you're in 12%, the money's going to double every 6 years. That means uh, the 10 turns into 20, 20 turns into 40, 80, 160, 320, 640, $1.2 million. Would you rather have $1.2 million? Or would you rather have $20,000? All we want to do is kind of shift this paradigm. Shift this paradigm. You want to borrow low and invest high. Borrow low, invest high. Borrow low, invest high. Borrow low, invest high. You want to be in accounts that's going to give you a better rate of return on your money. You cannot grow your money in a bank. You cannot grow your money in a money market account. It has to be in vehicles that's going to produce a better rate of return or compound interest. Now, compound interest really works when you're not losing money. We'll kind of get into that real quick. So, second rule of money. How does money grow? First way is fixed. These are your money market accounts, your CDs, your bonds. These accounts are really good for emergency funds, opportunity funds, but not for retirement and not for growth, because these are not even keeping up with inflation. Like my credit union, they offer they offer they offer a CD and it says it's getting 4% for 18 months. Well, I already know I'm doing the math. That means, yes, I'm going to get some growth, but it's going to take almost 18 years for that, excuse me, for that money I put into that account to double. Think about that. Now, the second way that money grows is in variable accounts. All right. So this is what most people have. They have a variable account. They got stocks, they got 401ks, they got Roth IRAs, excuse me, you know, just called, et cetera, et cetera. This is like a roller coaster, like an EKG machine. So the market's doing good, you're doing good, but when the market tanks, you lost part of your portfolio. In some cases, all of your portfolio. So most people, retirements and investments are tied together. Excuse me. What I want you to think about is separating retirement and investment. All right, your 401k is a retirement investment account. When the market's up, you're up. When the market's down, you're down. What happens if we go into recession? Keep on saying we're in a recession, we're not in a recession. You lose 30%, 40% of your portfolio. How would you feel? All right, so let's separate retirement and investment. If I'm investing, I know there's a risk. Well, there's a risk that I'm going to either make money, grow money, or lose money. And there's a risk tolerance. If I'm low risk, I'm probably not gonna make a whole lot of money. If I'm high risk, I'm probably gonna make a whole lot of money, but I also could lose a whole lot of money in my portfolio. And what they'll tell you is you gotta buy and hold. Yes, buy and hold. This is your other strategy. But when it comes to saving for retirement, doesn't make sense that you're losing money. All right. I'm a sore loser. I never like losing. I don't know when it became okay to lose money. So this is our safety net. If I'm saving for retirement, why do I have the potential to lose money? And this is where this strategy comes into place. Indexing. This is not indexing accounts, but it's a strategy. When the market grows, you grow. When the market tanks, you get locked in. When the market grows, you grow. When the market tanks, you get locked in. All of my clients during the pandemic never lost any money. They only made money. One of our clients, before she got with us, she had an old 401k account. She lost $90,000 back in 2023. How would you feel if you lost $100,000, $90,000? Right? You moved her over into an index account, and she's almost made that money back up just because of the large amount that she has in there. Number one, she got a bonus. Number two, when the market dipped, she didn't take any dips. She only made the gains. If you never ever lose, you can always win. This is a long-term approach to winning. Win, 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 win. All right. Think about that. So if you had to pick only one, which one would you choose? Or better yet, if there's a way that I can show you how not to lose any more money, but only make money, would you be open to seeing some numbers on a scale of 1 to 5? And that's what we're going to get into today is how do we leverage this account right here? Now, the third rule of money just deals with how we get taxed. We got to pay the tax man. Got to pay the tax man. So the first way we use to get taxed is always you got a brokerage account, you got a mutual fund. Your Uncle Joe said, hey, go out and get this brokerage account, go do it, get paid from your job, get taxed. You go get that account. If it grows that year, you're going to get taxed again. So, Jamal, it's a little bit too much. How can I avoid paying taxes? No problem. You go to your job. This is where most people are. Set up for the benefit package. You're vested. You put in more than the match, some of the match, a little bit of the match into your 401k, but your company told you that, hey, what we're going to do is we're going to delay taxes until you retire, until you're ready to put money out, and then you're going to pay taxes on that money. But imagine this. Imagine paying taxes. Well, do you want to pay taxes on a little bit, or do you want to pay taxes on a whole lot? We just got finished up in one of our seasoned elderly, but I don't. We helped somebody who was in their 70s. He's right up there for his distribution amount. So he had an old 401k. Now it's time for him to start pulling money down. And now he's at a higher tax bracket. So we start pulling that money down so we can tax on that money a little bit higher. Right. So I'm not going to bash the 401ks. They are a good system to save money for people who need an automatic savings. But be aware that you're going to be paying taxes down the line on a whole lot more money versus doing taxes right now. Now, tax advantage. This is what we say. Tax me right now, so I have to pay taxes again. So you can put money in this account. It's already been taxed. Money's going to grow tax-free. You're ready to pull it down. You can pull it down tax-free. Now, a lot more people are learning about Roth IRAs. They're a good program. Roth IRAs have some different restrictions. If you make too much money, you can't contribute to the Roth IRA. And at some point in time, you can max out your contributions. I think it's either at 6,500 or 7,200. I can't actually remember. Now, when it comes to life insurance, cash accumulation insurance policies, which is a permanent policy, there is no cap on how much money you can put into the deposits you want to own, the deposits you want to fund. There's two qualifications. Number one, it's a long-term investment. Number two, you got to qualify for it medically. So be committed to what you want to put into it. Number two, you got to qualify for it medically. All right. So that's the foundation. Let me go right back to it. So what we basically doing is showing you a growth phase, how to protect your money from any kind of market loss, and then when it's time to pull money down, how to pull that money tax free. It's easier to predict your money when it's coming down tax free. And this is drive the point home. Go pull up your statements. When you're losing money in your investment strategies, your 401ks, it takes you longer to recoup that money. So don't be fooled. If you lost 30%, let's go ahead and do it. If you lost 30%, you got to do 43% just to get back to your original amount. So once again, what we're talking about is just separating our investment strategies from our retirement strategies. If I'm saving for retirement, I don't want to lose money. This is my safety net. If I'm investing, I'm playing the crapshoot game. Either I'm going to be up or I'm going to be down. I just have to follow the right people and the right signs to make sure that I'm up all the time. Investments, you can't be emotional about it. With the retirement strategy, with the IULs, you can have a safety net, know that you're going to be fine. So we'll skip that. So let's kind of get into how does this work? These have to be properly designed. All right. So number one, this is a permanent policy. There are essentially 5 types of permanent policies. I prefer the IUL. You have whole life. You have final expense, which is pretty much a whole life policy. You have universal life. You have variable universal life. And then you have index universal life. Our whole life is what our parents have, maybe our grandparents have. Either you're doing 10 pay, 20 pay, 30 pay, lifetime pay, but you're going to get a set amount of compound interest happening depending on type of company. It could be either 4 to 5%, it could be a little bit higher. It depends. All right. Most whole life policies that I've seen are what we call level. That means it's a level death benefit. So once you start borrowing from your whole life policy, you can actually end up having less death benefit when you die. Uh, Either strategy is fine. Universal life, I'm not gonna talk about that. Variable universal life, your money is variable. This is going up and down with the market. The cash flow is your money. Index universal life, it's the index strategy. All right. That's what we talked about before was when the market grows, you grow, market tanks, you get locked in. So what happens is the amount you can contribute depends upon your death benefit. So life insurance was grandfathered in, and back in 1913, it basically says that any money goes into a life insurance policy, you can pull it out tax free. That's when somebody passes that death benefit, it's tax free. But also any money growing inside of that bubble is also tax free. So with your IULs, you basically what we look at is just how much do you want to contribute, your potential, and then what are your goals? Because you don't want to have too big of a bubble and it messes up your cash flow, how much cash flow you can have. You also don't want to have too little where you only have enough room to do a little bit of money in there. And we like to say it's basically like this. Hey, you got the safety of a bank. It works like an investment product, but it's not an investment product, but you do get a decent rate of return. And because it's a life insurance policy, we know it's going to be tax free. So write this down real quick. Go ahead and screenshot this. Real simple acronym. Perks. Protection. Protects your life, your health, and your wealth. You live a long time, you got money for retirement. You pass, your beneficiaries get your death benefit plus your cash value. I have a young man right now, when he passes, in turn 65, he can pull down $100,000 tax free up until he's 90 years old. When he dies at 90, he's still projected to pass down $2 million to his 4 kids. Right? So imagine that for 35 years, $100,000 tax free. And then when he passes, boom, he still can send his loved ones $2 million. Another stream of income is long-term care. Depending on the policy, you have long-term care attached to your IUL. Life, health, wealth, death. All right. Unlike 401ks and other accounts, there's no penalty for putting money down. You do got to follow the rules, but there's no 59 and a half rules, none of that going on. You literally can pull money down. So back during the pandemic, one of our mentors, his clients, they was in the restaurant business. Post restaurant shut down. She had an IUL. She started to panic, said, hey, I need to save my money, so I can't make my payments anymore. I said, hold up. Let me see what you have in terms of cash value in your account. She was able to borrow $12,000 from her account to take care of herself for the next 2, 3, 4, 5 months. No penalties attached to that. And that money was tax free. So on top of that, it's the best kind of retirement because it's tax free. Period. When you retire, it's easier to predict what you have coming in when you know it's tax free. So at least one of your retirement strategies has to be a tax free strategy. And I'm gonna say it should be an insurance based tax free strategy. For the babies, for the young adults, for the teenagers, this is a flexible plan. It's different than the 529 plan. You're not locked in just to educational costs. You can use money for real estate. You can use money for cars. You can use money to pay for a wedding. Uh, we're really going to dive into this college fund aspect of it next Wednesday. So if you got some kids, if you got some grandkids, if you got some godnephews, if you got some nieces, whatever, you got some brothers and sisters who got kids, invite them out to that meeting. And then on top of that, over the last 25 years, these accounts have averaged about 8%. So like I said before, there is a catch to it. You do got to qualify for these programs. This ain't for everybody. All right. Number one, you got to qualify for medically. Number two, you have to have the right budget to do this and discipline to do this. So if it's not there, we can work on getting you there. Uh, Long-term strategy. This is a long-term strategy. This is not the microwave stuff. This is not the get rich stuff. It's not a quick flip. This is not the quick flip stuff. You want to be able to be patient, let your money grow and grow and grow and grow for years down the line. All right. So these are just some average savings that our clients do. What I always say is that my new savers, they usually save between $200 to $500. My average savings do between $500 and $2,000, and my elite savings do between 2,000 or more. This is customizable to the individual. Now, depending on your age, I would tell you that that's a little bit too low of a payment, and we can't do that right now. But I will also say, hey, if you need a permanent policy in place, let's just figure out a good medium blend between there. All right, so does this work? Does this work? Does this work? Yes, it does. These are about 2-year-old transactions. So this person started this account in 2019 and 2023. They have a cash value of about $11,000. This account was started in 2023. They have access to about $20,000. So let's just say they needed to do an upgrade to their house. Instead of going to the bank, they can borrow from their own policy, put $10,000 down, renovate their kitchen or their bathroom, and boom. Once they flip that house, they can put the money back into this account. This account was started back in 2023. They got about $15,000 that they have access to. Okay. So uh, I met with the individual. This young lady. She's doing pretty good. She's in HR. She's making about 250K a year, and she kind of just wanted to see what would some numbers look like if she contributed to this account. She's in her 40s, and so no, she was in her mid 30s. And so I said, hey, you can put in money as long as you want, but ideally I want you to do at least 20 years. I'm not going to max it out. So IULs have ranges. This is really important for those other companies to try to beat down IULs. Before somebody talk you out of it, sit down with somebody else so they can explain to you what's going on, right? Because these are designed specifically to your needs. So there's a minimum and a maximum. You never just want to do the minimum. So her maximum that she could put in was about $5,000. I believe what we're doing for the first 5 years is doing about 2,000, and then we're going to max it out at 5,000. So look at here. In her first 5 years, is doing the mid premium. She's going to have about $90,000. What could you do with $90,000? In 10 years, she'll have about 231,000, and in 15 years, she'll have about $420,000. Now, you want to overfund these policies. You want to overfund these policies. You want to overfund these policies. So yeah, this lady's in her 40s. So if she was to max it out in the first 5 years, she has $120,000. In 10 years, she has $3,000. In 15 years, she has almost a million. Okay, so when she retires, she could put down almost $84,000 as part of her portfolio, as part of her strategy. So not a bad thing to have in your portfolio. Now, for the average person, um, you know, just doing just a little bit less, we had a smaller death benefit. Okay. Right now, she can only do about 400, but her goal is to do at least 1,000. So we designed this policy that she can have enough room, she still can put money in down the line. So as she starts to eliminate some of her debt, she has less child care expenses, she can put more into her policy. As she get raises and do different things, guess what? She can put more into it. So this is a strategy that we're going to use for her. First 3 years, she's doing $400 a month. Next 3 years, she's doing $600 a month. And after that, she's going to max it out. And as you can see, in 30 years, she's going to have about $500,000 that she has access to in terms of retirement. So IULs can be used for a whole lot. Tonight, we're only getting into like how does it look if I put money into it? How does it look if I'm thinking about retirement? Oh, on top of that, she has with this particular company, she has long-term care, she living benefits, power of attorney, healthcare directives, and will and online database storage. And so we'll kind of close it out with this right here. And if there's any questions, you could raise your hand, come off mic, and we'll answer those questions. The IUL is a powerful tool. It's not the end all be all. It does have to be designed correctly. You need to get with a professional. Go and scan this code. We have a team of individuals that we train. We will sit down with you, go from A to Z, do a financial need analysis, see if there's any holes or any money that we can shift around to fund these policies and to help you decide what's the best strategy for you to have in your portfolio. All right, so tax deferred growth. All that means is all this money is growing tax free. It's all tax free. Tax free distributions. This can cover medical expenses. So if you have a heart attack, you can actually pull from the value of your death benefit to take care of yourself. This can generate retirement income. It's credit proof. So OJ is a good example. You know, when OJ got in trouble, he actually got one of these policies to hide his money. Uh, it's backed by the strongest institutions in the world. Life insurance is one of the highest, is one of the safest industries in the world. There's no downside. You're not going to lose any money. It's only upside growth. I would rather gain money while people are losing money, or get locked in when people are losing money. Today was a bad day for the market. All my clients didn't lose any money. There's no required distributions like 401ks and Roth, depending on how your 401ks and your IRAs. At a certain age, you're required to pull money down. If you don't pull money down, then you're going to have to pay a penalty for that. So there's a lot of different things you could talk about. Um, we're going to close it out here. I just want to remind you, oh, that's our whole flyer. We want to remind you of our upcoming webinars. I hope tonight was informative. Normally it's a little bit more interactive. Tonight, I just want to just give you like the basics. Next week, we're going to have a panel discussion about the $1 Million Baby Strategy. So if you have any questions, either put them in the chat or come off mic or raise your hand. Even show your beautiful face, and then we'll close it out for the evening. I see Miss Jackie got your hand raised. What's the question that you have?
I don't know if you said it or if it was just too noisy where the ladies couldn't hear about if they are in a 401k or something, they're both in the medical field. Um, I guess expounding on the process of moving it and what's the penalties they wanted to know. Um, that process. I think one is sitting here that may be of age that's laughing at me. The other one may not be, but I didn't know if you covered that, you know, as
No,
far
I
as it being an age
so
or penalty.
yeah, it's a couple of strategies with 401ks. One strategy is doing what we call a rollover. A rollover a rollover is what we say is to do like a fixed index annuity. So there's no penalties for moving that money over into a fixed index annuity. It's the
Mhm.
same kind of strategy. You don't lose any money, and it's also an income for life. There's something else called a strategic rollout. It just depends upon how much is in your 401k, how we can roll that money out so that you're no longer in that tax deferred situation. Now you're in a tax free situation. So tell your nurses to get with us, and we can sit down and really dive into how that works. But yes, if you do have a 401k, what I kind of tell people is think about it like this: let us protect your retirement, and then once we protect that retirement, you can restart a new one. But you've been working in this field for 15, 20, 30, 10, whatever years. You have a decent sized nest egg. I don't want a recession to happen and you lose half of that portfolio. So you might be eligible that we can take that old money, that current money, put it into an account that never ever loses any money anymore. And if it's a fixed index annuity, you actually can turn on an income stream for life, right? Or we could do a different strategy depending on where you are, closer to retirement, and we actually can take that old 401k, do what's called a strategic rollout, put it into this IUL, and have it grow, do some different things for you, that kind of way.
Thanks.
No problem, no problem. And I believe, what's that QR code? So on these screens, yeah. If y'all scan these if you registered, I'm going to send you a follow-up email. But if you want to, if you're not on your phone, if you're on the laptop, you can take a picture of this scanning screen and you'll go to our feedback form and we'll get back with you. Any other questions that anybody has? Going once, going twice, and we are out of here. Uh, Thank you for being here. Please spread the word. Peace and blessings. I will see you at the top.
Thank you.
Thanks.
Hey, told me about all your insecurities for what? Drag me like 2 hours to your family's house for what? Time, but I should stick around.